So it's time to review REITs and see if they are worth your time. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend growth investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well. So I took a bit of a small break last week. So Vero, you went behind my back and you had an interview about REITs without telling me? What's going on?
Well, last week I had a great discussion with Daniel Foch about REITs and we thought let's make it even more straightforward because Daniel had a different perspective and I really enjoyed that. But REITs remain a common concern among our listeners and DSR members. We get questions about them at nearly every webinar. So this episode should provide a clear and concise guide to understanding REITs, what they are, how they work, and when they make sense in a dividend growth portfolio.
And it may surprise you, but it's not an obligation to have REITs in your portfolio. Sometimes you're going to realize after this podcast, oh, maybe it's for me, or maybe it's definitely not for me. They have a slightly more complex structure than a regular company. That also occurs more tax manipulation or implication depending on where you hold those REITs. So it's important to understand the nature of the business. There's nothing different than investing in a REIT or in a stock. You have to know which metrics to follow. You have to do your due diligence. And this is why we are doing this guide for you today to walk you through the different steps that you should be taking when you look into a REITs.
So Mike, let's start with some context. What macro and market forces have made life difficult for REITs over the past few years?
If you have invested in REITs over the past 5-10 years, mostly the past 5, it's even worse. You're probably not making much money. In general, you have to think how those business model works. So in general, they will use leverage to buy more properties, right? So regardless if you're talking about an apartment REITs or industrial REITs, and we're going to talk a little bit more about the different industries later on the road. But the main point is you buy properties, you leverage them to buy even more properties, get more tenants to pay rent, and eventually create some cash flow coming. That's a great way to build wealth, obviously, especially if you're a REIT, so you're getting to hundreds and thousands of doors. So that could work well. But when interest rises, it's not that easy. So interest rate kind of put a big stop on REITs growth. Plus the fact that several REITs were maybe a bit too aggressive while interest rates were lower. So that's one reason why a lot of investors are a bit disappointed right now. Less REITs are increasing their distributions also as opposed to what it used to be 10 years ago. And the other thing is also it's not a sexy investment. So investing in real estate properties, it's not a big hype such as investing in Tesla or investing in the new AI thing. So we are living in a world where a lot of hype and tech are driving the market. REITs are nothing close to this. Maybe beside one REIT that is Equinix because they are operating data centers, but that's pretty much the only one that and we're going to talk about it a little bit more longer, but that's about it. I mean, it's boring, it's stable, so not attracting much love from the market these days.
And maybe also, Mike, this context creates kind of a disconnection between the fact that since I'm 3 years old, I've been hearing adults saying you can never lose money in real estate. And then we see REITs having this hard time. So creates kind of a disconnection for investors, right?
Yeah, but I mean, that goes, we did an episode not too long ago about if you should invest in dividend stocks or not. And one thing was, well, don't take the dividend for granted. Many companies will pay a dividend and will not cut it, but it's the same thing for REITs. You could lose money investing in real estate, even if you're not even investing in REITs, but you're buying rental properties on your own. Bad tenants exist, bad properties that have major renovations that are required exist as well. I mean, from my banking days, I've seen landlords crying because they made a poor investment into a rental property and they lost a ton of money. So it's not true that you're not going to
Mhm.
lose money when you buy brick and mortar. And we're going to talk about that later on. But I mean, one thing that everybody loves about real estate is that you can see it. It's real. It's like, oh, you can touch it, actually. You can live in it. So that creates this sentiment of confidence, but it's kind of like a false sentiment. I mean, it's not because you walk into a
Right.
place, there is a roof that you're in safety. Sometimes you should not necessarily walk into a room where you don't know exactly what's going on in that apartment, right? So
Right. Okay, so there are different types of REITs: equity, mortgage, and hybrid, as well as a range of industries within each. Which categories or sectors have been hit the hardest?
So, to make a quick overview, you have the equity REITs, which is the most common. So, those are really just businesses using money to buy properties and then having tenants. The mortgage REITs are kind of like mini banks that are specialized in financing real estate deals. And those have been hit big time. The problem with them is, of course, on one side, they need to gather capital to be able to provide the financing. So the game here is to gather capital at a specific interest rate and of course being able to turn around and lend that money at a higher interest rate. So whenever there are like quick interest rate movement as we had over the past 5 years, well, it makes it very difficult for them to manage like the duration of all those contracts and the interest rates, and most of the time they get squeezed in the middle, and that is a specific type of mortgage that got hit big time. We also have the hybrid REITs, which is a mix of like a company that is investing capital into buying properties and also lending money to other to finance real estate deals. They're relatively rare. So most of the time we're just going to talk about equity REITs and mortgages. Now for the REITs in general, which industries have been hurt? Most of them in general, office REITs are probably the one that have the hardest time to recover in terms of specific industry. We keep talking about like people wanted to work remotely, which leaves wide office space empty. It's kind of funny because a few years ago, when people asked me like what I was doing at work, I was telling them I work online, I work from home. And they were just like, oh my God, oh really? And today they're all just like, oh, that's remote working. And I'm like, well, yeah, yes and no. I mean, I've started remote working like in 2008, but whatever. So, but it's kind of like it's super common today. Everybody does some remote work these days. So that means the need for offices is slowing down. And it's kind of like hard to convince those people to come back to the office, apparently. So, for that reason, they've been hurt big time. Besides the mortgage REIT, I think that this is the industry that was hurt the most. But then retail REITs, like especially those that are not like high quality retail REITs, like second tier or third tier shopping malls, for example, they have a hard time too due to e-commerce. But that was a trend that started way before the pandemic that just accelerated everything. High quality shopping malls are still doing well, though. There is a need for that, but it's just that it reduced the potential for growth as well. So the common thing besides those specific problem is the fact that interest rates have been rising, and even though now in Canada they have been reduced quite a lot, they're still not as low as all the great deals those companies had in 2020 2021. So even when they are
Mhm.
about to refinance, it's not as bad as it was a year ago, but it's not as great as when they got the deal. So their interest charges is going to increase, which is going to put more pressure on margin and on the business model as well.
Right. Now, what are REITs' greatest strengths and weaknesses?
So the greatest strengths, I've touched base on that a little bit earlier. It's super easy to understand, right? You see
Mhm.
it, you can get it, you buy a property, someone gets into the property, it's called a tenant, they pay a rent, and there you go. I mean, you're making money. It's kind of like your own making printing machine that you buy. The other thing is it distributes most of their income. So the taxation structure is a little bit different than a corporation, but it's favored for them to distribute most of their income to units holders. So there is also this like common need to get income. Many REITs will pay monthly their distribution. So you have, again, kind of like the feeling of recreating a pension or recreating kind of like a steady flow of income at retirement, which is great. And of course, it has this idea of like, well, if I'm buying real estate, it is stable. Like the properties are not going to go anywhere anytime soon. They're still going to be there. If you lose your tenants, you're just going to replace it, which also makes sense. So there is that feeling of comfort if you invest in a REITs. That's great for a lot of investors that are afraid of things that are moving too fast. On the weakness part, though, well, first, they're heavy on financing. So to grow, they need capital. So they will either issue more debt, which will put further weight on their business structure and on their funds from operation later on to pay the distribution, or they issue more units. So if they issue more units, it's like a company issuing shares to make an acquisition that dilutes the value, put pressure on the unit's price. And if your unit price goes down, your total return will get hurt. And on top of that, which is important, is the more units you issue, the more dividend you have to pay, even if you maintain the same dividend. Well, if you have 10 units and you pay $1 a unit in dividend in distribution, that's $10. But if you're issuing another 10 units, now you have 20. Well, you're still paying the same dollar per unit, but now your total distribution paid is $20 and you have not increased your
Right.
dividend. So that's also a problem for them. It kind of like put a more brake on the growth perspective. So, and this is usually what something that you find when you invest. The more stable you get, the less growth potential you have. It's like investing in a GIC, super safe. You know the interest rate in advance. It's super stable. Is there any growth beyond the interest rate? Absolutely zero. So there is that game of stability versus growth potential. It also lack of flexibility. A good example is Ryocan, which is one of the largest retail REIT in Canada. And over the past few years, they saw that their business model was a bit flawed in terms of their growth potential for shopping malls, probably not what it was like 10, 15 years ago. So they decided to move towards having like apartments and selling condos, which is a smart move. But you will not sell all your shopping malls in a single year and then all of a sudden start building plenty of projects and like condo towers and stuff like that at the same time. So it's hard for them to move once they are set in a business model. It's like you have like long-term mortgages, you have like properties that you're expecting to hold in your portfolio for like decades. So it's not something you're going to turn around very quickly. And finally, it's maybe counterintuitive for some people, as you mentioned, because when you invest in real estate, you cannot lose money, but they're not any safer than any other type of equities. So you invest in National Bank, you invest in Alimentation Couche-Tard, or you invest in Canadian Apartment REIT, same issue. It could go well, it could go bad. There's nothing that is like better because it's a REIT. It's just
Right.
a different business model, a different industry. It's not safer, it's not riskier. It's you have like great companies there and terrible one as well.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you. So please spread the love. Thank you. Mike, your strategy revolves around the dividend triangle, which is positive 5-year revenue, EPS, and dividend growth. How does this concept apply or maybe need to be adjusted when analyzing REITs?
Yeah, so the problem with the dividend triangle is it's based on three gap metrics. So the revenue, the earnings per share, and the dividend. For REITs, we're not really using the earnings per share because first they have like a large part of amortization in their financial statements, which is a non-cash event, but would definitely show very low earnings per share. And of course, at the same time, a bad payout ratio because the payout ratio is based on earnings. So that's really not the right metric to use. You then have to rely on funds from operation per unit or adjusted fund from operation per unit, so FFO or AFFO. And that kind of replace the earning per share in the dividend triangle analysis. If you find a REIT that is able to grow their FFO per unit year after year, it means that they generate more money per unit. So the chances are they will also be able to increase their distribution.
But what's like the common mistakes investors make when evaluating a REIT using the wrong metric?
Well, the thing, as I said, is they will not calculate the right payout ratio. So they will think that the distribution is not safe at all, while it's not true. So confusing earnings per share with FFO. That metric is actually the FFO is the earnings plus the amortization, depreciation, minus the proceeds of sale. So you don't want also to count when a REIT is selling a property that is like a big inflow of cash, but that's not sustainable. So it's great for
Mhm.
1 year, but the following year, it's either being reinvested or being spent on whatever, but it's not going to be a recurring. So you want to have something that's more recurring. The other mistake they will have is to discard the net asset value, the NAV. So the NAV per unit is the total property fair value. So what's the buildings, the properties are worth minus the liability. So that's like the underlying like net worth basically of the REIT. And if you're
Mhm.
seeing a company that is actually destroying its NAV, so either the properties they purchase lose value for whatever reason, they made a bad investment, or they keep on remortgaging everything, and then there's a real estate crash and the fair market value are not as good as before, well, then you have a REIT that has like no possibility of refinancing in the future either. So that is like
Mhm.
super important to see a REIT that does not finance their properties to the maximum. So you have some room. It gives a little bit more flexibility, because the other way around to get financing, if you cannot remortgage your properties, is to issue more units. And as I told you before, if you do that, well, you're going to run into some kind of other problems. We've seen this for several companies where they kept on issuing more units, but at one point, the market did not want to buy those units. So the value dropped
Mhm.
faster. And now the dividend is still to be paid to those units. So that creates a big cash flow problem, because on the one side, you have a lot of kind of like a debt, because the distribution is like money that is going out of the business, but you have no way of getting more cash flow in, because you're stuck not being able to issue more debts and you're stuck not being able to issue more units at the same time. So those are like common mistakes. If you ignore those metrics, going to be a big problem down the road, or you're not going to be able to identify those problems.
Another concern some investors have is the tax implications of REITs. What should investors know about REIT tax treatment and how should they plan around it?
They should go see their accountant. I hate talking about taxes, of course, but here's the thing.
I know.
If you have REITs in a taxable account, you're not getting dividends. I know I've used that word like several times during this show, but it's just because it's easier and it comes out of my mouth like faster. But it's really distribution. The difference is the dividend is taxed differently than a distribution, and the distribution could include, for example, return of capital. And return of capital (ROC) is getting your money back. So there's a good point of that, is you're not paying taxes on getting your money back. So that's great. I mean, you got like $1 in return of capital. That dollar is really in your pocket, but it will decrease your adjusted cost basis. So the cost that you paid to buy those units is going to be decreased accordingly to the return of capital that you receive. So the longer you hold the REIT, the lower your book cost will show. And then when you sell, you will trigger a higher capital gains. So again, the best way to manage all of this is to go see an accountant, or have all your REITs in a retirement account that is tax sheltered. So then you don't have to worry
Mhm.
about all of those things. If not, that could get a little bit more complicated.
So, like you've kind of mentioned in the introduction, not every investor is a good fit for REITs. So, in your opinion, who should consider adding REITs and who might be better off avoiding them?
If you are looking for growth in like mid single to high single digit, most of the REITs are going to be a big disappointment for you. The REITs is a good solution for anyone looking for a stable income, in a sense where many of those pay monthly. It's a greater recurring source of revenue. And if you're looking more for stability, in a sense that they don't move fast, so they are likely to be less volatile, assuming that you're picking REITs with strong financial metrics, of course. That is going to help you. So I don't think it's everyone that should have like a lot of REITs, but if you're just looking for a monthly income and you don't care too much about the total return and you don't care too much about the potential growth you're leaving on the table, and that's totally fine, because you have like pros and cons on both sides. Like REITs should be probably a good part of your portfolio. On the other side, if you focus a little bit more on total return and you want to see some growth. I'm this kind of investor. The only REIT I have in my portfolio is Granite. And every time we talk about it, I just mention that I'm down on it. And it's like one of the rare holdings that I'm actually losing money on it. So not too
Right.
sure why I did that. No, just joking, because the metrics are still good, but the results are not. But as long as the metrics are good, I'm okay with that. But still, it's definitely not keeping up with the rest of my portfolio. It's kind of like when you look at your hockey team and you have this guy's always late for practice, always misses the shots, always like don't know where to pass the puck around. Well, this is Granite in my portfolio right now. But he's paying for the beer. He's a good guy. He really wants to do something with the team, but he's just not up for it right now.
Okay, so I'm guessing that maybe you don't have much, but which REIT industries are your favorite and why?
You got it right. I mean, having said that, there are some industries that are interesting, though. I kind of like the apartment REITs industry, mostly because when you think about that, when the housing market goes too hot, well, a lot of people will rather rent instead. So there's that common sense of like getting a steady flow of tenants all the time. When you see a REIT in the apartment industry with a high occupancy rate, that's going to be good. Another industry that I like is industrial REITs because I believe we need more specialized industrial properties, and most of the time companies are super happy to let the management of the property to a REIT instead of like having their own. So that's another one. And of course, data centers. We just talked about Equinix, but this one is quite interesting. If I was looking for stability, there are some retail REITs that are very solid on both sides of the border, but we're going to talk about that a little bit more later on today.
Yeah, so what traits define a well managed REIT? Like, what should investors look for in management and strategy?
So, to craft your investment thesis, you would need to look at their investors' presentation, read some earnings calls. And one thing that you're looking for in those documents is having a clear plan, especially for growth. Because it's one thing to say, yeah, we are in apartment REITs, we're buying apartments. I mean, yeah, well, we got that part. It's quite obvious. So, what are you doing? So, if you have like a specialized apartment REIT like SX Properties, for example, the ticker is ESS, they are specialized in specific cities or areas. So, mostly in California and Seattle, they are operating around tech hubs. So, their goal is to provide high class apartments to young workers working for tech companies, having a lot of money to spend, but they don't necessarily want to take care of a home. So you want to provide a very nice apartment with a lot of like services. So those people, they can just pay a monthly rent and they don't have to take care about anything. That is an interesting business model. It's very specific and it will help you to craft your investment thesis. The other thing is if you want to narrow down your choices very fast, just put a positive dividend growth rate over the past 5 years, and boom, you're going to find about 40 REITs across Canada and the US. That's only 40 companies that actually manage to maintain a growing dividend growth policy around over the past 5 years, which is kind of surprising because besides COVID, which happened within a few months, we did not go into a big recession or anything else like this. So it tells you how difficult that's been with higher interest rate for REITs to keep up with increasing distribution. Still not easy to find REITs that are performing these days. So not necessarily looking at like the past 12 months or the past 5 years total return, you're going to be a bit disappointed. But again, you go back to the classic, looking for a REIT that shows the ability to grow its revenue. Most importantly, grow its FFO per units, because it's one thing to grow funds from operation, but if you're issuing more units every single time, you need to look at the per unit metric and then looking for REITs increasing distribution.
Okay, so let's use real examples to make things concrete. Which REITs are worth investors' attention?
So I have a good list. On the US side, I've already discussed Equinix and SX Properties, so I'm going to leave both
Mhm.
of them. Equinix is probably the REIT that shows the strongest growth path over the past 5 and 10 years. It's almost like a very exciting company, but it's a REIT. That's the only difference, but they are growing because they are offering data centers, so that's doing very well for them. On the commercial side, we have Realty Income, NNN REIT, and we have Vici Properties. All of those have been able to increase the distribution for a long time. What I like about Realty Income and Triple N is the several different tenants, and it's most of the time like single tenants property or like 2-3 tenants in a single property. So they're not like large shopping malls, and they focus on great location. Most of their tenants are a little bit more e-commerce proof as well. So those are like great characteristic. For Vici properties, most of their tenants are casinos. They contract for like 40, 50 years. So that brings a little bit more stability. They're definitely a niche type of REIT business model, but it's going well for them. On the Canadian side, even though I am not reporting great returns, I still like Granite, mostly because of its diversification and its ability to grow. They have been growing their revenue, their FFO per unit, and their distribution for over a decade now. And it's very stable, very reliable, high occupancy rate. They have everything to please. Besides having Magna International as their largest tenant, that is about 26-27% of their revenue. So that's probably like the biggest problem here. You have Canadian Tire REIT, CRT. This one, it's quite obvious, like more than 90% of properties are actually Canadian Tire. But again, been able to grow revenue, FFO per unit, and distribution for several years now. Very stable in Canada too. And on the apartment REIT, we have Killam, KMP, and Canadian Apartment REIT that shows great occupancy rate, the ability to grow their distribution most of the time, good payout ratio. Again, not that type of REIT that is going to bolster your portfolio and show double-digit returns, but definitely something that if I'm looking to sleep well at night, I wouldn't be worried too much on this one.
Listeners, let's empower you in the investment world with our free dividend Rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. All right, Mike, you recently wrote the DSR investment roadmap to help people build a long-lasting dividend portfolio. Would you use the exact roadmap to select REIT?
Definitely. So what is great about this roadmap is it has been created to give you a process. So the process, you can adapt it if you're looking for low yield, high growth stocks. You can adapt it if you're looking for stable and mature businesses, looking for blue chips. And you can also adapt it for selecting REITs. So it's really a step-by-step method where it helps you defining your goals, defining what you're looking for, defining the metrics that will help you find what you're looking for, and then pulling the trigger, clicking on that buy button, and finally move on with a complete and well-diversified portfolio.
Listeners, you can download your free copy of the investment roadmap now at thedividendguyblog.com/roadmap. Simply enter your name and email and you'll get it in your mailbox. Again, thedividendguyblog.com/roadmap. Let's talk about underperformance, Mike. When a REIT is struggling, like you've mentioned, Granite, how should investors approach the review process? Like, what are the true red flags versus just market noise?
I would say it's very similar to any type of stocks in that regard. So a lot of investors tend to give a value to the recent stock performance. So same thing with the REITs. Oh, my REITs is down 20%. It's a shitty REITs. It's not exactly how it works. That's part of like the market noise, of course. So what you're looking for when you want to invest in a REIT is similar to any type of other businesses. You want a business that has ability to grow. You want a business that is able to grow but make more profit and and of course, increase their distribution. So whenever those three metrics, which are the equivalent of the dividend triangle, but for REITs, are valid, I would tend to hold on to my shares and just focus on that distribution. On the other side, many REITs over the past few years stopped increasing their dividend. Most of the time because of higher interest charges or lower occupancy rates. So those are like signs that there is something doing not that great if the REIT is not able to renew their tenants and then the occupancy rate goes down, or they have a bad tenant. So that is something else. Those would be red flags, because yes, it's one thing. Oh, I have a bad tenant, it's leaving, so I'm going to replace it. But maybe it's going to take you like 6 months, a year, 2 years to fully replace all the properties that this tenant was in. And if it's the case, well, that means lower FFO for several months or years, potentially affecting the distribution policy at the same time. So it's all about the numbers once again. And the numbers are a bit different, but it's pretty much the same. If the business is not able to grow, it's stagnant. If it's stagnant, they hit 1 or 2 bumps on the road, and then it's going to get closer to cutting down the distribution. Because I mean, it's kind of like the purpose of a REIT is to pay the distribution. So they are directing a lot of their cash flow toward the distribution, which is a great thing for investors until the REIT is struggling.
All right, so we've discussed a lot of things today, and I really want you listeners to get as much value as possible. So Mike, could you walk us through the key steps investors should follow when investing in REITs to summarize this episode?
Yeah, so take a pause to grab a piece of paper and a pen, because there are a lot of things to discuss here. So first, you're going to start. It's similar for all investment processes, but this one, you have like a few metrics to look at. So first, you're going to look at the goal. What is your goal? Have you, after this show, did you understand what the REIT is going to do in your portfolio? It's going to bring some stable income, some cash flow, but it's not going to skyrocket. So knowing this, then you can move forward to see which kind of industry you like. And as it is super important when you look at sectors, it's also important to look at industries. Do you understand apartments industry dynamic? Do you understand offices? I mean, if you were surprised because I just told you that there are less people that wants to be in an office today, well, that's because you don't understand much how office properties are working. Same thing with industrial properties or any others. So it's important to understand the industry as well. Then you have all the metrics. As I said, what I would do is use the dividend triangle approach, trade the earnings per share for the FFO per unit, using the FFO and AFFO payout ratio as well. A big focus on the payout ratio trend and a big focus on the distribution trend will tell me a lot about the metrics overall. So now you have your goal that is set up. You have selected specific industries that you are interested in. You have filtered out using the dividend triangle metrics. Now it's time to look at each REIT's business model. And by business model, I don't just mean, oh, I buy a property, I get a tenant, and I get money from, but look at the average lease term, for example. Depending on the industry, the lease term, I mean, for an apartment REIT, the lease term will be close to a year. So then you need a higher stability there, because every year you have tenants that are going to move. If you are looking at industrial REITs, it may be 5, 7, 10 years, which is great. Commercial REITs, same thing. VICI properties, as I said earlier, those are like 40, 50 years contract. Well, then it's great because it's super safe, but you want to make sure that you have escalator contracts, meaning that the rent is already expected to increase over time. You have triple net lease term like NNN that is doing triple net. Triple net is putting more responsibility, more expenses in the end of the tenants. So they're going to take care of like the property, they're going to take care of the taxes, and the insurances. So you're less responsible for the property, but you're also going to make a little bit less money. So again, the relation of risk here that is being shared with the tenant as opposed to someone taking care of all the risk. Another metric that is important to look at is the occupation rate. I've discussed that earlier today, but if you see occupation rate going down, and we have discussed a while ago the case of Allied Properties, which was quite interesting to follow, showed a great speculation play, but one thing that I kept on repeating is follow the occupation rate. So it was an office property REIT, and unfortunately that metric kept on going down. So during its glory days, it was above 90%. So then you say, oh, that's great because they're maximizing their property value. They're getting a lot of cash flow because they're filled with tenants. When you go down to 89, and then the next quarter is like 88.5, and then 88.2, and then 87, and so on, well, then you see a trend where the REIT is not able to renew their contracts, which is one thing. But on top of that, they're not able to find new tenants. So it's a sign that
Right.
something is struggling around here. And of course, rent collection. This sounds kind of like obvious, but during COVID time, rent collection was quite a challenge. So a lot of like companies had like benefited from pause. And then you verify, well, is the tenants are actually great or not, which is a big part in the analysis as well. So analyzing tenants. Fortunately, if you look at the investor's presentation, most of the time the REIT will publish their top 10 or top 20 largest tenants. So then you can see if the REIT has a dependency on like one big tenant, such as I mentioned, like Granite at like 26% of their revenue, or the entire REIT, which is it's like 90+% Canadian Tire. Well, then you know that if that business has a problem, the entire REIT has a problem.
Right.
On the other side, you can see the industry of each tenant. So that is useful for commercial REITs. So you see if they're all like dollar stores or they are convenience stores, like movie theaters. So you can see if they're like well diversified or they could get hit by a similar type of event that could help you in your analysis. And finally, you have the geographic diversification. Is the REIT concentrated in a specific state or province, specific country? Do they have like properties around the world? So that could be a good thing or a bad thing. As I mentioned, SX Properties is focused on tech hub cities. That could be good, but if we have a tech crash, well, they're not gonna have much fun. On the other side, you have like well-diversified property REITs such as Granite that is operating across the world. So if there's a recession in a specific country, they will be less affected overall. Now that you have defined the business model, looking at the lease rate, the rent collection, and the diversification for both tenants and geographic diversification, time to look at growth opportunities. How the REIT finds ways to improve their situation. Are they recycling assets, which means that they buy properties, they revamp them, make them more profitable, and then resell them? That's asset recycling. So by selling them at a higher value, you get more cash flow, you can do more projects. So it's a good way to improve the cash flow of the REIT without having to issue debts or issuing units. So that's great. It could be by investing in new projects. So either buying properties or buying lands and building properties that are specific for a different type of usage. Again, that will require financing, but if the management team has demonstrated that they are able to grow but keep the FFO unit growing at the same time, you don't have to worry too much about distribution. Your income's going to come in, and that's going to be also a great way to do. So identifying growth vectors, this is how you're going to do it. Again, the investor's presentation, the earnings call, super important to tell you what the management team is doing to make the REIT better. And finally, well, you have also the potential downsides. That's kind of like wrap up your investment thesis and your analysis. You need to find out what could go wrong for REIT. So I said multiple things today. So it could be a big tenant. It could be a big concentration in a specific market. It could be that people don't want to rent your stuff anymore. So occupation rate goes down. Could be interest rates. It could be a lot of things. So you have to line them up and determine which kind of risk you prefer to have in your portfolio, because no investments are perfect. They all have risk. They all have like potential threats. It's just about knowing which one you like the most or you're more comfortable with and you can deal with them when they happen. So yeah, that's it. I'm going to take a sip of water now.
Well, listeners, maybe you have guessed it, but REITs looks like they seem very simple, but they're not so simple to analyze. So take that in note. And if you have missed any of the information, visit our show notes at thedividendguyblog.com/234. We always have like summaries and key points for you to not miss any important things. So thanks a lot, Mike, for your guidance on REITs. Listeners, make sure you grab your copy of the investment roadmap. Enter your name and email at thedividendguyblog.com/roadmap to download it now for free. Again, show notes and related content at thedividendguyblog.com/234. And I will also put the link to the episode I did with Daniel Foch from the Canadian Real Estate Investor podcast. And if you like what we do, thank us by hitting the subscribe button underneath our podcast logo and leaving us a 5-star rating. Until next week, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.